NASDAQ has rolled a little bit as well, which is right now down about 2/3 of 1%. But Belski, I'm going to go to you because the NASDAQ is part of your story here.
It is.
You've seen the move in tech, which you've upgraded as well, but now your price target goes to 45.50. It's the second highest on the street, only to Sam Stovall, who was 45.75. Obviously, you figured I would give you the business too much if you went to the highest, so you had to go just under that.
That's exactly why.
I'm inside your head, dude. So what's up with this, really?
So thanks for having us. We, across the board with all three of our scenarios, increased our price targets by 250 points. We just thought that was apropos, especially given where we thought the worst case scenario did not occur this year. That's kind of number one. Number two, from a fundamental perspective, when you decrease the cost of capital and you decrease our equity risk premium and you decrease kind of what's happening in inflation, that helped us equate to our dividend discount model to pump out a bigger number. Now, the first thing you're going to say is Belski 20 times, right? You're going to say that. And my retort would be, coming out of bear markets traditionally, and we wrote about this in our year ahead piece, that you see 6 multiple points increase from the bottom. We're about halfway there, so we still think there's still multiple expansion. I would like to note, though, this is the very first time that we're overweight technology since 2019, and that's kind of a big call for us. And so we're getting a lot of feedback, let's say, that we're late on tech. I don't think we're late on tech. I think this is just beginning. And so we really think that the secular bull is still very much alive, our 25-year call. We think the market bottom in October. And we think that there's more upside. Now, it's not an exciting number. We're talking 6% upside.
Well, I mean, after what we've already had, it's kind of exciting to think that, you know, where we came into this year, you know, with many assuming that it was going to be a tough year, at least for the good part of it, you know, for all the obvious reasons, the economy slowing down, the Fed still highly engaged. I think a lot of people would take 45.50.
Yeah, I think very much so. And again, I hope I'm wrong. I mean, our bull case scenario is 50-50, meaning 5,050, and that would be an all-time high on the S&P 500. I think we really need to see earnings get cranked up. And as we said in our note, obviously the institutional investors we speak with and the market itself is really positioning for 2024 earnings. And this 220 number that our number is for 2023 looks like a pretty good number. It could be a little bit higher, but we need to see significant contribution from tech the second half of the year to make that number a lot higher.
So you clearly were moved by the strength in tech, unforeseen by you and many others, obviously, from the beginning of the year, enough so that that's enough of a driver. And by the way, you're not the only one who thinks there's potential further upside to the S&P and earnings as a result of what's happening with AI. David Kostin at Goldman Sachs says further upside to S&P is possible if investors see profit and productivity from AI, which they obviously do.
I think one of the biggest misses that people aren't talking about is coming into this year, Scott, next 12-month earnings for tech were actually modeled for below the market, okay, below S&P 500 earnings. And what we've seen over the last 4 or 5 months now, tech is beginning to surpass on an earnings growth rate. So revisions clearly, meaning earnings revisions on a fiscal year basis, clearly bottomed out. Now they're beginning to recover. So we're starting to see the semblance of not only earnings stability there, which has been our call all the time with with tech, but earnings acceleration, and I think that's what's really going to guide it.
I think what's clear is that this AI revolution has blindsided the market, blindsided investors, blindsided some companies that were in the space that got blindsided by who was going to take the alleged lead in the arms race that we're witnessing, and now we're trying to play catch up. Well, in some sense.
I think very few had factored in the contribution to earnings that generative AI was going to realize. And it's a reality that's here, it's now, it's present. We saw it in NVIDIA's earnings. I think it's concurrent with positioning, which coming into the year was massively underweight technology to a level and an extreme that we have not seen since the great financial crisis. But ultimately, I think it comes back to leadership. And I think for the very first time since 2019, we've identified the potential leadership for more than a moment. If you go back and you reflect through 2020, we've had these periods of fits and starts. It was the work from home leadership. it transitioned to the vaccine and the reopening and the roaring 20s trade and the cyclical trade, but you could never establish consistent leadership over a significant period of time. And I think, Scott, you have the potential for that now, and that would lead you to doing what? Erasing the U from the conversation of the earnings recession and having the expectation be it's a
right.
V.
And I think the most confounding thing for most investors, Scott, has been there've been 3 tech rallies this year, right? You had the January effect rally in January, where the majority of leadership came from the worst performers in 2022. Then you had the rotation out of financials into tech. Then you had the AI boom, right? So I think a lot of investors on the first 2 missed it because they didn't believe it. Now they're all of a sudden believing it because the fundamentals in the earnings are starting to come through, and that's why I think the move is real.